Good morning or good afternoon, everyone. Whenever or wherever you're watching this video, thank you for watching this video and subscribing. I hope everyone is having the best day or the best week of their life. If you found value in today's video, make sure to hit the subscribe button for more videos like this. Most of my videos are usually about investing, health, and life. Today's video is going to be about mistakes made by new investors, or current investors too can make these mistakes as well. Leave a comment with what your biggest mistake was when you're investing. And do you still make the mistake? Or what did you learn from the mistake? Let me know in the comments below. Let's try to hit 7,000 subscribers in 7 months. With all that out of the way, let's get into today's video about these mistakes. One of the biggest mistakes I see many new investors and current investors make is they don't do their research. They just go on Reddit, they go online, they go on YouTube, and they just find stocks that people recommend, and they're like, okay, I'll just buy this stock because they're buying it. But some people don't know that other people have reasons why they're buying that stock, and their intentions, might not be that great sometimes. So you should do your own research. Make sure you like the company, make sure it has a great balance sheet, make sure it's a great investment for you. Also, you want to keep in mind capital gain taxes when you're investing. So if you're trying to day trade and swing trade, then these are something that you might want to consider. So I will do a video on capital gain taxes so you guys can know what that is if you don't, and how that can affect you, and how that can affect what you're making. This leads me to number 2, which is only buying hype stocks. There's a lot of hype stocks out there, and people are just hyping things up. Even cryptocurrency, you have people hyping up Dogecoin, Shiba Coin, everything else. They try to make it look easy, but it's not. You just don't want to buy hype stocks because eventually the hype will run out, and it might backfire, if you don't exit. And a lot of us have the tendency of not exiting our position, and we don't have a plan to exit our position. We just keep thinking it's going to go up, people are going to hype it up. And then you end up losing a lot of your money because people already left the hype. For example, we had the marijuana stocks. When people were talking about legalizing it and all this other stuff, the marijuana stocks were all shooting up, and people were making money off of it. Eventually the hype died out, and then the stocks came back to realistic value. And so events like that will just hype stocks up, and you just want to find a good exit strategy and walk away with some money. Another mistake I see people make is selling on the first drop. Just because you see a stock drop a little bit, 11%, 20%, it might even be dipping 7%, 9%. You get scared and you abandon ship instead of sticking with your gut and realizing you've done your research and you know this company and you know what it's worth. And the funny part is, you sell the stock and then later on it shoots up 30%. So you would have made that difference back with that stock that you just bought. But it's all because you didn't hold onto the stock and believe in it. The next mistake I see many new investors and current investors make is because they see a stock dipping, they don't average down, which is a really cool strategy, and I really love doing it. Is you can always average down in your position. So if you bought Facebook at $100, you don't need to go all in and buy 10 shares of Facebook. What you could do is you can buy maybe 5 shares of Facebook at $100, and when it dips down to $90, you can set a limit for another 5 shares at $90 instead of buying 10 shares at $100, because then your average will be the $100. Instead, you could always average down. So it's always better that you average down. If you see a stock dipping and you really love it, you don't have to go all in at once. You can always average down your position, and it will make your average costs a lot smaller. So when it does shoot back up, you can always make that difference, and it'll be worthwhile. Another mistake I see many new investors make, and current investors, is mistaking trading with investing. Those are two completely different things. Trading is like when you're swing trading or day trading, you're just holding the position for a certain amount of hours or maybe in a day or two, and it shoots up 3%, 6%, whatever, 7%, and you collect that money, but you don't realize at the end of the day you're paying capital gain taxes. So the government's going to take a lot more. If you were to hold for a year or more, then you'll be paying a lot less in taxes. And I really like long-term investing. That's what majority of my portfolio is about. I do a swing trading and day trading with a little bit of money, but majority of it's long-term and dividend investing. So that's another mistake that you want to probably avoid. Investing is you're holding in the company for a long time and you're expecting the company to do amazing things, have a great balance sheet, free cash flow, acquire other companies, and continuously grow. And in the long term, the company's price for a share grows as the company grows, and you may end up making more money that way. Don't try to time the market because it won't work. But what you can do is find a good entry point, do your research, find a price that you're comfortable paying for a company or a stock, and then put a limit buy for whatever price that is. And then let's say you're at work or you're in the gym, wherever you're doing, you're out traveling, the limit gets filled for you automatically while you're doing whatever it is you're doing at work or traveling or wherever you're doing. And then you enter that position and you just hold the position for however long you need to. And if you invest in a solid company, most likely that position will go up and you'll end up making some money. Now there are some amazing growth stocks that you can enter too, but those are more risky right now. As you can see, all the growth stocks are down. The next thing I see many new investors make this mistake is overcomplicating your investing. Don't overthink something. Follow your gut. Do your research. Look at the balance sheet. Look what the company's doing. Look at their management. Look at their employees. Are they happy? Are the employees not happy? Are they losing a lot of people? Do they have a high turnaround? Is their balance sheet not showing enough free cash flow? Are they losing money? Are they not investing money in more assets? These are all different things that you can think about when you're investing. Try not to overcomplicate it. With all the stuff that you already presented, just use that information and make your judgment based on that information. There's plenty of resources out there. There's more resources now than ever. And it's literally all on the internet. It's your job to make the decision. Do your research. Find out what's valid, what's not valid. There's a lot of rumors out there too, so you want to be careful you don't follow the rumor or the hype, as we talked about earlier in this video. The next mistake most new investors or current investors make is overly diversifying. Yes, it's good to have a diverse portfolio and great to have different stocks and stocks for different reasons, growth, dividends, etc., whatever the reason might be. But when you have overly diversified stock portfolio, that means you're just diversifying too much into different sectors and different companies, and eventually it's going to be overwhelming where you can't manage your portfolio. And you just realize, oh, I don't know how to manage all these stocks or which ones I really want to eliminate. So you should narrow down what stocks you want to put in your portfolio and narrow it down to a certain amount for each sector. Let's say information technology, consumer staples, dividends, growth, genetics, all the different sectors that you can think about. You just want to make sure you have a certain amount, a certain percentage of your portfolio dedicated to that sector or to a certain stock. You don't want to have too many stocks in the same sector, so you want to diversify that way. And then, so it's good to diversify, but not overly diversifying your portfolio. Too much of a good thing can be a bad thing, because most of us do not have time in our busy schedule to maintain and always be looking at our portfolio and managing the portfolio. For me, like example, I'm a long-term investor, so most of the days I don't have to look at what stocks are coming in and out my portfolio. I know what's going in and I know what's going out and why I'm selling, and I have reasons for why I'm selling. And I have a certain limit to what stocks my portfolio are dedicated to. And for each sector, I try to limit it to a certain percentage in my portfolio. Another mistake that many new investors and current investors make is copying a YouTuber's stock picks or even a Reddit stock pick. Like Wall Street Bets, yes, you can go on different websites and copy other people. And yeah, it might work, but it might also backfire on you because majority of people are just buying and selling for the short term. And they're just looking to gain profit for that week, that month, or a couple of days. And then they get rid of the stock and you end up holding, getting too greedy, and you realize the stock is losing money for you because you didn't get out in time. So you want to be careful copying other people's picks because that can backfire on you. So it's always great to have your own picks and realizing this is what stock I want to invest in, and here's the reasons. If you don't have a reason to invest in it for your own reasons, not for other people's reasons, then you shouldn't be investing in those stocks. And this includes me too. It doesn't exclude me. It means if I pick a stock, I have my reasons. I've done my research. I see potential in the company, so why not invest in it? That's why I invest in the companies I invest in, because I believe in their future. I know their management. I know their balance sheets. I know what they have capabilities of doing and not doing. And everything else that I can think about that's publicly information that I can do research on. I go find the information and I just use it to my advantage. So this is why you don't want to buy based on dividend yields or high dividend yields, is because the dividend yield can backfire on you and the company could slowly decline in the share price, but it could still pay out the dividends to attract new shareholders, to attract new people to buy the stock. Just because you see a dividend yield, they're like, oh, okay, I'm going to go buy the stock. But then the stock shoots down and you end up losing the money instead of making the money that you should have on dividends. So you want to find a nice stable stock and then use that dividends to keep reinvesting into that same company or other dividend stocks that you might find attractive. And make sure, they have amazing balance sheet, free cash flow. They're reinvesting the money back into the company. They're not paying too much to the shareholders to attract more people to buy just because the dividend is high. Another mistake many new investors and current investors make is thinking that low PE ratios are always a buy. Just because a company or a stock has a low PE ratio doesn't mean it's always a buy. Low PE ratios can be tricky because you still want to make sure the price to earnings is always, stable within the company. It's not trading too much into the future. It's not trading. So the PE ratio helps you predict the price of the stock for the future. So if you see a high PE ratio, that's how much they're predicting the future growth is going to be. Times, let's say if it's a PE ratio of 200, then they're predicting the stock to be 200 times the worth that it is currently, based on their future plans, their future products, the way they're innovating their current product lines, or their future product lines are going to be amazing. So you can't be always basing based on low PE ratio. Just because a company has a low PE ratio, they still need to be doing things towards the future and still innovating, still being creative, still offering products that satisfy the customer's needs and the demand for the customer. A PE ratio relative to its peers or historically means investors are expecting high future earnings growth, thus are willing to pay more right now, or a lower PE suggests investors believe earnings growth may slow down going forward. For example, Amazon has a PE of over 100 as of April 2020. Compared to other online e-commerce companies, this is high, meaning investors believe the company's earnings grow will outpace peers in the near term. The PE ratio is a simplistic term, is how much $1 of profits cost to invest in the company. In Amazon, as an example, investors is effectively paying $100 for every dollar of profits. Again, the PE ratio sometimes is referring to as earnings multiple. It is a good measure of value on standalone basis. Instead, it's best used when compared to industry's average or its historical average PE ratio. Let's say we wanted to get the PE ratio for Tesla. So how would you get this? You would take the cost of the share, which is $1,022.11, and then you want to divide that by the EPS, 490. So if we were to do that, you would get a PE ratio of 208.593877. We can keep going on, but let's say we were round, it'll be 209, which is the PE ratio as this website is stating, Yahoo Finance. The next mistake I see many new investors and current investors make is paying in expense fees. So you might see fees for OTCs, mutual funds, or OTCs. OTCs you can purchase using like TD Ameritrade, Charles Schwab, other brokerages that allow for over-the-counter purchases of stocks. So when you purchase these stocks, there's sometimes, or not sometimes, there's always a fee of $5 when you're making the purchase. When you put one order in, it's $5. For example, I use TD Ameritrade, so they charge $5 when I buy OTCs. And then they charge another $5 when I sell those stocks, those OTC stocks. And then there's also fees when you're buying ETFs and mutual funds. These expense fees where people are managing the ETF or the mutual fund for you, and you get a certain percentage of returns. So you want to make sure you're not overpaying on these fees. So always want to be aware how much the fee is, why they're charging the fee. Are you making good returns, or are they just goofing off with your money? So you always want to keep track of these, because eventually the expense fees can add up. Another mistake I see many new investors and current investors make is using margin investing. Margin investing is where you're borrowing money from somebody and they take collateral such as a ring, a car, a house, or something like that, and they give you money for it as collateral. And then you can use that money to buy stocks and keep buying stocks. And the reason I don't recommend you doing this is because if you keep borrowing and borrowing and then you're taking all these risks, now you're taking more risk because you're borrowing money from someone else instead of using your own cash. That's why I highly recommend using a cash account instead of a margin account, because a cash account lets you be in charge and you know how to manage your money, because it's really important that you know how to manage your money, just like you know how to manage your time. And managing your money makes it very important for things in life like budgeting, planning trips, planning for future purchases, having an emergency fund. And then you can hold yourself accountable, because when you have a cash account, you don't have to worry about it because it's your own money. And you're going to never try to risk your own money for stupid reasons. Instead, you're probably going to be smart about it and do your research when you're buying stocks and educate yourself about the company before investing into the company. Instead of if you use a margin account where you're just gambling and you're just, borrowing money from someone else, and that someone else is going to come after you if you don't do too good. Some of the risks that might happen with a margin account are, let's say scenario one, the stock price rises. After you purchase your own $20,000 worth in stocks, you still owe the broker $10,000, and the value of the stock serves as collateral for the loan. So that's one. Two is the stock price falls. Leverage can be amplified losses in the same manner. Let's assume that the same stock position, but instead the stock price declines. Another mistake many new investors and current investors make is investing based on emotions. You should never buy a stock or a company based on emotions. I see many people still do this, and they're like, okay, other people are buying this. Oh, let's ride this hype stock. Let's go buy this stock because they're doing amazing things. But you should never, buy your stocks based on emotions, because eventually those emotions can backfire on you. So it's always great to just do your research, look into the company, look into their finance, look into their management, look at their goals, look where everything's headed, look what the company's doing for the world, what is the company solving, what major problem is it solving for the world or people. So these are different questions you can ask when you're looking into a company. And there's countless other questions that you can look around and see if you can answer those about the company. And it might help you better understand the company, not based on emotions, based on logical and research and what you have on paper, what you have on the company's site. Because eventually those emotions can backfire on you. So it's always great to just do your research, look into the company, look into their finance, look into their management, look at their goals, look where everything's headed, look what the company's doing for the world, what is the company solving, what major problem is it solving for the world or people. So these are different questions that you can ask when you're looking into a company. And there's countless other questions that you can look around and see if you can answer those about the company. And it might help you better understand the company, not based on emotions, based on logical and research and what you have on paper, what you have on because eventually those emotions can backfire on you. So it's always great to just do your research, look into the company, look into their finance, look into their management, look at their goals, look where everything's headed, look what the company's doing for the world, what is the company solving, what major problem is it solving for the world or people. So these are different questions you can ask when you're looking into a company. And there's countless other questions that you can look around and see if you can answer those about the company. And it might help you better understand the company, not based on emotions, based on logical and research and what you have on paper, what you have on the company's site.